Hi everyone, welcome back to Be Rich. It's me, Vinod, still recording remotely from Bangalore. It's been nice, the weather here. Kind of rained yesterday, so the city's had a nice wash. It's looking rather fresh. I hope wherever you are, the weather is nice and you're in a great mood, as I am. Today, I wanted to talk about what's happening in terms of the treasury market in the US. And I done a video a few days back about short-term bonds and Warren Buffett and cornering the market. Some more news has come about that and arguments on why you should only look at treasuries in terms of the bond or debt market or the credit market as they call it in the US. And I'll make my argument in case there, and I would love to hear your feedback. Tomorrow I have actually done a deep dive into AMD again because a lot of you have been asking about AMD, about the deal which has happened in Saudi and the deal in India and the impact on the company and is it on value right now. That is something I will dive into tomorrow. So if you have any questions or comments aligning to that, put it down below and I'll pool all those together and try and answer it as I do the video tomorrow on AMD. But today I wanted to first get to the comments which you guys have dropped in the video. So thanks for the comments. Thanks for the encouragement. A lot of you are happy with what we're trying to do here on Be Rich platform. And thanks for enjoying the journey. I do love it being a small collective, a small tribe. Much easier to have conversations and to keep it going with our regular viewers. I'm not too upset about the numbers, view counts, as some of my editors are, like Rupesh. So, God bless it. Anyway, talking about comments, Prasanna Venkatesh 6826 says, keep rocking the global markets and global company. Don't let the comments asking money pages talk. Yeah, so basically saying keep rocking. So I guess thanks, Prasanna. Thanks for you are right. IBKR does give us access to global markets sitting in India, so it is a great platform, and I do use it personally. And I too believe having a spotlight on global stocks and that to the world's largest market makes a lot of sense for everyone, including our fellow viewers and tribe members of MoneyPage and Be Rich and all the other channels which we have. And next one was Pavan Srinivasan 1553. Is there any stock like ITC which is a Chiranjeevi, as Anand says? Well, ITC is a rare stock and a rare beast. It is not owned per se by a promoter, and it's a professionally run company, and it's a dividend player, steady cash flow. Now they're entering the FMCG in a big way and diversifying and moving away from tobacco because it is a dying industry, tobacco, which I actually wanted to cover in another video. Probably I'll do it on Saturday maybe. I haven't been researching about tobacco companies, especially the ones in the US, and the economy that's changed with vaping and the new regulations. Taken me a bit of time, but I will come to that. So anyway, coming back to ITC, yes, they're pivoting away from tobacco, which is good. And in terms of Chiranjeevi, I don't know. You can look at other companies too, but remember, no two legends are the same. Some people say Cipla, some people say Tata Elxsi. I don't know. I don't think they're the same caliber as ITC because it is truly a company on its own. Mr. Chandru12 says, what is the difference between provision coverage ratio and capital adequacy ratio? Good question. Provision coverage ratio is amount of money the bank buffers to cover bad loans, NPAs. So if the bank is seeing some NPAs on its books and sees it coming, they have set aside some money which is known as a provision. That's what the word provision means itself. It's providing for some future problem that may come. So the ratio is of course one divided by the other. So taking a certain amount of their money and keeping it aside, that is known as provision. So they're providing for anything that goes wrong so it doesn't impact their business. Capital adequacy ratio is more holistic. It's about the bank's overall strength to withstand financial stress. Let's say that's a global market recession or a catastrophe of sorts. Is a bank having enough money to withstand that? Or even in a small level, if it's a personal thing, let's say someone spreads some false news about the bank and everyone starts running to the bank, withdrawing the money, does the bank will be able to cover that position? So this is what capital adequacy ratio is all about. Ajay Krishnan 9338 says, can you explain what Mr. Anand meant in the Richest Man Babylon video about term insurance with money back? I couldn't fully understand it. Well, thank you, Ajay, for watching Anand's video. And I love that you noticed that and you picked on that money back term insurance. What he's trying to basically talk about is we tend to, you know, be penny wise and pound foolish. We take a term insurance because in case something goes wrong, it covers whatever liabilities we have and the people we have left behind, they're taken care of, and none of the mistakes or the loans we have taken, affects them. So that is the main purpose of a term insurance, to take protection for your loved ones. And people forget that and they lose sight of that by looking at getting something back. They're saying, I'm paying for term insurance only if I die. In case something happens to me, will I get money? But what if I don't die, or if nothing happens? To all that money goes to waste. So if you're giving me something also now for the money I'm giving you in case I die, so it kind of gets convoluted, right? So what Anand was talking about is in term insurance, if you're chasing short-term returns, you lose the cover which you're supposed to get. You're diluting your cover. So maybe I'll try and do a longer video on term insurance and how the coverage works and how it's diluted if you link it to some policies and all these hybrid term insurance, why they're not really great. I will try and do a video on that soon. JS Rajan says, can you do a video on Cisco? Sure, I will definitely do a video on Cisco. I think I did do one some time ago. Maybe I'll do a follow-up on this. It's a great company and it has a great moat. And the question is the price right? So let me dive into that and come back to you. And one of you had said IBKR is a great thing, but it's a little complicated for beginners, and currency conversion costs and all that, and the annual inactivity fees. So if you keep your account idle, it's all there. Maybe I should do a complete cost and benefit for IBKR and how to use it as a beginner. Some of you have been struggling with that, so let me put that in the pipeline too. And Janiki Raman SU8R has been asking, which is better to buy, Japanese shares in yen in Nikkei or ADRs in the US? Also, can we buy less than 100 shares directly in Japan? Well, it's a great question. Yen does give you the full stock, there's no question about that, but maybe this minimum lot size rule you have to check. ADRs is much more easier for investors like us, over most investors, because we're already in the American market and it's very easy to pick up these ADRs. But you're right, all Japanese companies are not available as ADRs, and fractional investing is possible on a platform like IBKR. Like I said, I should do a video on that and walk you guys through that. But you're right, it's purely your call. There's not one is better than the other. Both is ownership, both are stocks in the company. So you are becoming a business owner. Which is easier for you? You will have to decide depending on the platform you're on and how easy you're finding to invest. So that takes care of most of the comments. The rest are all, giving me encouragement, which I thank you guys for. Today, what I want to talk about was there's an article which came out in Financial Times about Citibank sounding the alarm and saying the rise in bad loans and there's provisioning for that. So what does that mean? Because Citibank is not like a small bank, it's a global bank, and they do a lot of their business is with private equity businesses. They have all like a lot of business loans is what happens. So them warning this and growing concerns about credit risk and what you call recession coming on thanks to the macroeconomic headwinds and the rising cost of credit thanks to the Fed and the tariffs. They're saying in the near future we may see a default on. So they're worried about that. So they're increasing the provision. Even Jamie Dimon from JP Morgan had been sounding about the American economy, said it could deteriorate soon. So he's also seeing the problem, and he's saying there's an inflection point which is maybe coming. He says consumers and businesses can't see this. Nobody can predict it, how it happens. He says maybe it is coming. So he says the reason why he said that, and he laid it out in that speech, was he was talking about private credit and how it's exploding in Wall Street. I did do a video about Shashwat on this about a few months ago, and he's again sounding the alarm on this, and he says this could become a fault line in an event of a recession, because he says the private credit is different from what banks are doing, And they set up these deals, these banks set up these private credit deals, and then they move them off their books. Meanwhile, investors are left holding the short straw, looking for returns in the long term on asset quality, which is questionable. So how does this work? In short, what it means is banks, short-term risk takers, more transactional is what they're doing, and investors like you and me are looking long-term, where the risk holders exposed to this credit which the banks have given. So the quality of credit counts. A lot of you may find that very confusing when I'm saying it, so let me put this in a very nice way. First, you have a company, okay, ABCD company, and it has an idea. And for this idea, it needs to borrow some money. So it goes, approaches the bank, pitches the idea to the bank, and says, can you give me some money? I'd like to execute this idea. The bank manager or the bank credit team looks over this proposal and say, okay, looks like a great idea, and lends them the money. And the company takes the money and they go about doing whatever their idea was, and the bank is collecting the interest for this loan. But the bank needs to continue doing business because it's already lent the money, so it needs the cash back so it can rotate it again. That's what transactional is, what Jamie is saying. So what does the bank do? It takes it, creates it into a product which promises returns, and chops it into pieces, and in turn sells it to investors. This is what happened, if you remember, in 2007, 2008, which led to the financial crisis. So they parcel this up and sell it to investors like pension funds and other big investors. And they in turn buy it from the bank at a discount, and the interest is collected by them from the company. So what Jamie is saying is, this is all very good, but the problem is there has been a sudden uptick and a greed for this kind of private credit business on Wall Street, and it's been driving up this private credit business up. So there's a lot of bad loans which are being given out. Quality is questionable. And he says, in case of a recession coming on and there's a squeeze, a lot of these will collapse, and this, he says, could become a problem. So he says he wants, if he was a fund manager right now, he will not be buying any of this credit at the spreads they're offering, at the prices they're offering. Meaning, says the price is way too high for the risk the investors taking on. The yield is just not worth it. So he, in turn, what he's telling you silently as an investor is, you're better off looking at treasuries in the short term, which is what I was talking about. So again, this goes back to what I was saying. Even Warren Buffett has cornered 5% of the treasury market. So if you're looking at ETFs in treasury bills, if you're not able to buy the T-bills, you have small sums of money sitting in the US or abroad, and you want to invest in something safe right now in the US because you're not able to decide. Instead of looking at corporate bonds in the US, what we should be looking at is the T-bills. The 3-month T-bills are very good because the Fed has very happily kept the interest rate up for us still, and there's no credit risk over there, and it's highly liquid. So things like iShares S-Gov T-bills, which is 3 months, or the SPDR bills, those T-bills, or iShares SHV, which are a little longer, can go up to a year. So this is what it means. So does this mean it's time to panic? No. But what Jamie is trying to say is the risk is there. So when do you reassess your T-bill position is the question next a lot of you might have. So when should you reassess your T-bill is when you see the credit spread going up. That means there's panic slowly coming into the market. Remember, we spoke about the US long-term bond rates going up, the yield, and we explained about that. Same thing similar in the corporate bonds. If you see the spread going up, that means the yield coming up. That means you can revisit this. There's panic in the market. At that point in time, you can look at buying high yield bonds or corporate bond funds at that point in time, of course, of good quality and not something just because it has a high interest rate. So this is something I wanted to get out to you guys on, again, reinforcing the idea of T-bills. And if you have liquid cash and you do not know what to do with it, the best thing to do right now is to park it in T-bills and sit on the interest. I know it's very boring. It's not some fancy long-term stock, but you can take the interest which you're getting from this and look at other stocks in the market. So I hope you found this informative and entertaining as always. And I did enjoy recording this for you remotely as always. And nothing else more to say. Tomorrow I'll talk about AMD, and I'll probably get into the tobacco video after that. That is something to look forward to. If you have any comments, questions about this T-bill, about IBKR, I do understand I'll do a video on that, or anything else, please drop in a comment. I'll address it the best way I can. As far as Indian stocks and Indian news are concerned, I am talking about it in great length on Instagram. and I'm putting up videos on WhatsApp over there, and you can catch those. That today I'll probably be talking about microfinance and the microfinance industry in India, and why RBI did this rate cut, and do an explainer on the implications to microfinance and the play which you should be doing in microfinance in India. Anyway, thanks for watching the video as always. It was fun being here with you. Nothing else more to say other than good evening.